Hello and welcome. We are doing part two in our series on an intro to investing today. My name is Danica Waddell. I am the president and founder of Zena Financial Planning. And as I said in the last video, if you missed that one, we are just going through a series on just kind of the basics of investing. So the first part of the series was just defining stocks and bonds, how they work, how to think about them. Today, we're going to talk a little bit about mutual funds, ETFs, and some other different types of investing. So, yeah, there it is, basically. So different styles of investing actually is also what we'll touch on. So sort of the difference between active and passive investing. We'll define what mutual funds and ETFs are and how to think about those, and then just some different alternative types of investments. Okay, so to get started, I wanted to just give a little overview on how to think about active versus passive investment styles. So active investments are just like they sound. It's more hands-on. There is somebody that is more engaged in picking specific individual stocks. So there will be a portfolio manager, more than likely an entire team that is picking the actual funds that go into, or the actual stocks that go into their particular fund. So an active investment could be a mutual fund or an ETF, but essentially it's just, there's somebody actually making a decision about it, specifically which things go into that basket of stocks or bonds. With passive investing, there isn't somebody that's just saying, oh, I like this company, I don't like that company. It's much more, they're just trying to match a benchmark or an index specifically. So that could be an index like the S&P 500 index, and you're just trying to match that exact index. Active investments, typically there's a lot of buying and selling, so there's a lot of churn, which can increase fees and just usually means lower returns, to be honest. Passive investing is much more, there's much less buying and selling. It's a lot less turnover, and the fees are lower. So essentially what you're paying for with active investments is, somebody to make those decisions about which stocks to choose. Because passive investments don't have that additional layer of somebody making those decisions and that paying that team, basically, the fees are lower. So with active and passive investments, I think the most important thing to keep in mind is that active investment strategy is essentially trying to outperform the market or trying to beat the market. Passive investments just want to stay with the market, but active, they are trying to specifically do better than the market. And historically, active management doesn't really outperform. So they might have a couple good years and then not so good. And so we really, over time, active management, it's not really worth paying that extra money because the performance isn't there in a consistent way. So mutual funds and ETFs are very common ways that people invest in the stock market, and a lot of people are confused about what those are. So again, just wanted to do some basic definitions and talk through how to think about these two different things. But essentially, a mutual fund is just a collection of stocks or a collection of bonds or a collection of stocks and bonds. So you might have a mutual fund that is, like I was talking about in the last slide, that's just trying to match, say, the S&P 500, or that's just composed of large US stocks. You might have a more balanced fund that has stocks and bonds, or any variation thereof. So there really is no limit to the different types of mutual funds that you might see, but it's really just a collection. So rather than buying an individual stock, you might buy a mutual fund that gives you exposure to lots of different individual stocks. The difference between a mutual fund and an ETF, there's a couple differences. One is the fees are usually higher with a mutual fund. They're slightly more likely to be actively managed than passively managed. So ETFs, you can have an actively managed ETF, but I tend to see more passively managed ETFs. So you're likely to have higher fees on the mutual fund side. The other big difference, which more than likely you might not really notice or it might not directly impact you, but is in how they're traded. So when you buy a mutual fund, it doesn't settle until the stock market is closed. So at the close of the stock market for the day, then you can actually buy the mutual fund. The ETF version, you can buy and sell throughout the trading day. So there's just a slight difference in how you would actually purchase one or the other. And then the last thing that I think is most important about ETFs is that they're often more tax efficient. So that can be, if you're buying something that's in a taxable account, you might be more interested in a tax efficient fund versus if you're in an IRA or some other kind of retirement account that might not be quite so important. And so I'd say, one way that many of you will probably see mutual funds in your portfolio is in a target date fund. So if you have a 401k through your employer and you're investing in some kind of, Vanguard Target Retirement 2050 fund, that is basically designed to be a fund that gives you very broad access to lots of different types of the market. Almost certainly going to be a mutual fund. So you're going to see mutual funds show up pretty regularly inside of a 401k. A couple other types of investments that I think are worth calling out. I don't think that most people need these things. So these are things that, if you're higher net worth and or you have a more, complex situation, there might be a reason for these. But for the average investor, I'd say we're looking at generally investing mostly in just stocks and bonds. But a couple other things that I think are just worth knowing what they are, and again, a little bit about how to think about whether or not they make sense for your situation. Real estate, when we talk about real estate in a portfolio, I am not talking about your residence. So if you own your home, that's definitely part of your net worth. It's definitely part of your financial picture. I would not consider it part of your investment portfolio. If you have rental properties, particularly if you have several rental properties, that might be something that we would consider part of an investment portfolio. But you can also buy real estate in your investments. So you could have a real estate fund. A REIT is sometimes a word that you might hear, which is a real estate investment trust. So you can own real estate via a fund inside of your portfolio, but typically, certainly a residence, I would not include as part of your investment portfolio. Commodities, I don't see a lot of these currently, but you may have heard of them. If you've seen the movie Trading Places, you probably will remember a lot of that movie centers on commodities. But commodities are essentially, raw materials or an agricultural product. So think of things that are, often tangible, not manufactured, like we're not talking about a TV or something, but things like coffee, gold, oil, other sorts of natural resources and agricultural products often show up here. Again, I don't think most people need these in their portfolio, but you may hear about them occasionally. And then other alternatives would include things like private equity, hedge funds, cryptocurrency. Private equity and hedge funds in particular, you're going to usually pay a pretty penny for those things. So the fees are often really, really high. And again, for the most part, I don't think the performance necessarily warrants their inclusion in the average person's portfolio. Cryptocurrency, a little bit more of a recent phenomenon, but that is definitely considered an alternative investment, definitely a little bit more volatile than more the stocks and bond traditional investments. And then art and wine collections. Sometimes people have, an extensive wine collection that's considered part of their investment portfolio. Pretty unusual to see that sort of thing in any significant way, but that may be something that you're interested in and would probably constitute a very, very small part of your total portfolio. Okay, that's actually as far as we're going to go today. So I hope that was helpful. I think the last thing that I'll just wrap up on saying, because I didn't really talk about the different types of indexes very much, but when we go back to mutual funds and ETFs, I think it's important to understand, sort of what an index fund is. And so often the ETF side is just matching a specific index, and that could be an S&P 500 index, it could be an international index. But what an index is just, a representation of that segment of the market. And so, for the most part, our strategy is definitely on the passive side. Index funds and ETFs are definitely what we focus on, as I think the performance is generally good and the fees are very, very low. So, those are that's just a little bit more clarification on indexes and index funds, which can be mutual funds or ETFs, could be an index fund. So I hope that's helpful. In part three, we are going to be talking about pitfalls. We're going to talk about, the trade-offs between risk and return and some other considerations as you are getting started on your investing journey. So I hope that you will continue to follow along. If you have questions, feel free to send them to hello@zenafp.com. And all of this presentation is for educational purposes only. So if you have a financial advisor, tax advisor, or legal advisor, that's who you should talk to about specific recommendations. So this is just for educational purposes. Okay, see you next time.